video I'm just going to discuss briefly some of the strengths and weaknesses of monetary policy. Only a quick 3-minute video. So a couple of things about the strengths of monetary policy. One, it's politically neutral. So basically that means that their decisions are all free from bias and the government cannot manipulate what they do. The government will only override what the RBA do if there's a really big discrepancy with what they want and what the RBA are doing, but it's very, very rare. And most of the time they're politically neutral, they're accountable to the public, and they're not biased by trying to win votes or anything like that. The other thing, it has a short implementation lag, which basically means it takes little time, I should say, to implement monetary policy. So once the RBA announces that they are going to increase the target cash rate, they will quickly change the target cash rate and make the cash rate close to the target. So the time between them announcing that they're going to announce a higher or lower target cash rate and the actual cash rate changing is really, really quick. Unlike something like budgetary policy, where the policies can take a long time to get through Parliament, the RBA, once they've announced they're going to do it, they just do it straight away, and they buy and sell securities to have that impact. It has a really big and powerful influence on expectations. So even if the government just has concerns about inflation and puts those concerns out to the public, consumers and investors will quickly think that interest rates are going to rise and be less likely to spend. So it can have a big impact on what consumers do and a big impact on what they're saying. It also has it's a really powerful weapon for manipulating aggregate demand. So it's the primary weapon used to try and slow down the level of aggregate demand when we're in a peak, and is really effective at slowing down our economy in a peak. Slightly less effective when we're in a trough because of a couple of reasons, but mainly because consumers have weak consumer confidence and they're often likely to deleverage in a trough, so it may be less likely to stimulate spending through lower interest rates. So it's the key macro management policy, it's the key demand policy to try and stimulate demand. But the main positives, it's politically neutral, they're accountable to the public, has a short implementation lag, it has a very strong impact on our expectations and on our decisions, and it's really effective at slowing down the level of aggregate demand. Some weaknesses, it can't specifically target living standards, so it can really only work to stimulate aggregate demand through people's interest rates they're paying and their buying decisions, but it can't target specific sectors of the economy, it can't target sort of equity or low income earners, and it can't really directly impact living standards through getting rid of negative externalities or anything like that. So it can't target market failure. It's a blunt instrument, so what I mean by that, again, pretty similar, but it can't target specific areas of the economy, so it can't stimulate or slow down spending in specific areas. So for example, if Tasmania is growing really slowly, but WA is growing really fast, budgetary policy is more effective at targeting unemployment within a certain sector, where monetary policy can't do that. It has a really long impact lag, so even though the cash rate changes fairly quickly after they announce it, it can take a long time, and I've said that in the past, up to 2 years before changing the cash rate can impact other interest rates and then flow on through investment and consumption spending. So the problem with that is that the RBA is trying to predict what inflation will do in the future, and if they get that wrong, it can often lead to monetary policy not having the impact that they would like it to have, or working in a pro-cyclical manner, increasing the size of the trough when we're in a trough because they may have increased interest rates not knowing that we're going to get into a trough. Another problem is that the RBA doesn't have any direct control over interest rates. They only manipulate the cash rate through buying and selling securities, and the banks will not always pass on the lower or higher interest rates, and therefore that can limit the effectiveness. So basically any interest rate in the economy is based on demand and supply. The RBA only have limited power in changing the interest rates. They can only really change the cash rate or the target cash rate and try and change the cash rate, which will hopefully flow on to other interest rates.